Hi everyone. We are now going to take a look at some practice problems for Chapter 11, starting with problem 11-19 on page 549. So now we're looking at some differential analysis to help us make decisions. So this problem deals with, should we drop or retain a segment? Let's take a look. Jackson County Senior Services is a nonprofit organization devoted to providing essential services to seniors who live in their own homes within the Jackson County area. The three services provided for seniors are home nursing, Meals on Wheels, and housekeeping. The next page, we're going to look at some data and revenue for the past year. So we can see there the revenues, variable expenses, which lead to our contribution margin for each area, fixed expenses that won't change, leading to either a net operating income or loss. The head administrator of Jackson County, Judith, considers last year's net operating income of $5,000 to be unsatisfactory. Therefore, she is considering the possibility of discontinuing the housekeeping program. Okay, the depreciation in housekeeping is for a small van that is used to carry the housekeepers and their equipment from job to job. If the program were discontinued, the van would be donated to a charitable organization. None of the general and administrative overhead would be avoided if the housekeeping program were dropped, but the liability insurance and the salary of the program administrator would be avoided. So let's take a look to see, is there a financial advantage or disadvantage of continuing or discontinuing the housekeeping program? Should it be discontinued, and explain? Well, first of all, let's take a look. The contribution margin lost if the housekeeping program is dropped would be $80,000. Now, what would be avoided? The liability insurance and the program administrator's salary. So, $28,000 would be lost if they give up the housekeeping. Now, depreciation is considered a sunk cost, and the van has no salvage value, since it would be donated to another organization. So you can't get any of that money back. The general administrative overhead is allocated, and none of it would be avoided if the program were dropped. So that's irrelevant to our decision. So if they keep, or I should say, if they get rid of the housekeeping, they would actually end up in a deficit or decreasing their net operating income overall by $28,000. Not a good idea. Prepare a properly formatted segmented income statement that would be more useful for her to assess long-run financial viability of its various services. So, if you take a look, what are we focusing on? Well, we want to start with our revenues, and we want to subtract our variable expenses based on those revenues to get to a contribution margin. Now, each service provides a positive contribution margin. Then we want to deduct the traceable fixed expenses to that particular activity. So you could see those are the depreciation amounts for each activity. Those are the liability insurance policies for each activity. Those are the program administrator salaries who run each activity. It tells us that those general and administrative overheads are allocated based on revenue. So they're not for a specific activity. So really, all the activities are positive. It's just the general and administrative overhead contributes to that being a low overall net operating income. So this will help the administrator maybe make a better decision about what should be done with the various programs. So in the format that it is now, it's not proper in the book. You need to make it more more accurate with the amount that is actually occurring in each activity to make good decisions. And that's what we're doing here. Okay, now we're going to go to problem 1122. Pulaski Company manufactures and sells a single product called a RET. Operating at capacity, the company can produce and sell 30,000 RETs per year. So that's without buying any additional equipment. Costs associated with this level of production and sales are given below. So 30,000 RETs, direct material $15 each, gives us a total. 30,000 RETs, direct labor at $8 each. Variable manufacturing overhead, fixed manufacturing overhead, variable and fixed selling expenses. So the total cost to make a RET is $45, and at total capacity, 30,000 RETs, we have costs of $1,350,000. The RETs normally sell for $50 each. Fixed manufacturing overhead is $270,000 per year whenever we make between 25 and 30,000 RETs. So our fixed overhead would be in that range when we make that level of RET. So let's take a look at the questions. Oops, 22 we went. Assume that due to a recession, Pulaski Company expects to sell only 25 RETs through regular channels next year. A large retail chain has offered to purchase the other 5,000, so they would be still operating at maximum capacity. If they could have a 16% discount off the regular price of $50. There would be no sales commission on this order, so the variable selling expenses would be slashed by 75% of what they're currently at now. But Pulaski would have to purchase a special machine to engrave the retail chain's name, and that machine would cost 10 grand. There's no assurance that any future sales will occur from this retail chain after they sell these 5,000. So should they accept this special order? Well, let's take a look. How much will it cost? How much revenue will they make? And is it positive or negative afterwards? Well, the sales from the order will be at 84% of $50 because they're taking a 16% discount. So the selling price per unit would be at $42 times 5,000 units. Revenue would be $210,000. Direct material costs would still be at $15. Labor would still be at $8. So we multiply each of those by the 5,000 units that this special order would encompass. Manufacturing overhead stays at $3. None of that changes from the special order. So that would be a $15,000 cost. The variable selling expenses, though, will only be at 25% of the $4 because there's no sales commission, 75% of it would be slashed. So now we're looking at $1 per unit or $5,000. The special machine costs $10,000 or $2 per unit. So per unit wise, we would have a profit of $13 per unit. Overall, $65,000. So yes, we will take this special order. Now in number 2, it says, well, refer to that data. Now assume they only expect to sell the 25,000 The U.S. Army would like to make a one-time purchase of the other 5,000 RETs that they could produce. They're going to pay $1.80 for them, though. And they would also reimburse Pulaski for all costs of production to make those units, variable and fixed. Because the Army would pick up the RETs with its own trucks, there would be no variable selling expenses associated with this order. So now looking at these variables, let's fit them into our information. First of all, how much money will the company receive as reimbursement? Remember, they said they're going to reimburse their variable and fixed overhead costs. So the variable cost would be $26, $15 in materials, $8 in labor, $3 in variable manufacturing overhead, plus the $9 in fixed variable overhead. So they'll get a reimbursement right off the top of $175,000. Then they'll receive $1.80 cash for each 5,000 unit. So they'll also receive from the Army $9,000. That's the selling price, essentially. So the total revenue they'll receive is $184,000. Now it goes on to say, remember, go back there. There would be no variable selling cost associated with this. Okay. So how much would it cost to make these? Well, the variable production cost would be $26 per unit times 5,000 units, $130,000. Remember, the fixed costs are the same no matter if they make 25 or 30,000. So we're focused on the variable here. We're going to get reimbursed the fixed up in the top. That's why we included those. But when we're trying to determine if we should accept this, we focus on variable because fixed, they're there, they're sunk. We got to pay them. So the financial advantage of accepting this order would be $54,000, even though it may not sound like it at first. Oh, $1.80? No, in the end, it is. But let's take a look at scenario 3. Let's assume that everything's the same in 2, except the company does expect to sell 30,000 RETs through the regular channels. How much would it be financially advantage to them to still take the U.S. Army's order or to sell them to the general public? Well, the revenue from making the RETs above $184,000 for the U.S. Army. How much would they have charged for those RETs to the general public? $50 a unit times 5,000, $250,000. So they're going to decrease their revenue $66,000. Now, the positive side is if they accept the Army order, they won't have that $4 variable selling expense. They will have it if they use and sell to the general public. So there is a savings there by taking the Army's offer, but they're still overall down $46,000. So the answer for this scenario is only sell to the public. Even though you're going to have those extra selling expenses, it's still worth it. You'll still make $46,000 more by selling to the public. So this is how we take and we look at our variable costs. Remember, fixed costs, they're there. They're there no matter what. Unless your level of activity forces you to incur more fixed costs. But that's not the scenario here. No matter how many we make between 25 and 30, we always have the same fixed costs. So they don't need to be even used in our determination of accepting a special order. So that was for special orders. Now, our last scenario, problem 1123, is for trying to decide, should I make something or should I buy it? So Sylvan Industries, basically to cut through the first two paragraphs, they make a lip balm. I'm in the third paragraph. It's called Chap Off. The product will be sold to wholesalers in boxes of 24 tubes for $8 per box. Because of excess capacity, no additional fixed manufacturing overhead costs will be incurred to produce the product. They already have enough room. However, a $90,000 charge for fixed manufacturing overhead will be absorbed by the product under the company's absorption costing system. So using the estimated sales and production of 100,000 boxes of Chap Off, the accounting department has developed the following manufacturing cost per box. It's going to cost $3.60 in direct materials, $2 in direct labor, and $1.40 in total manufacturing overhead. The costs above relate to making both the lip balm and a tube that contains it. Now, what the company has considered doing is purchasing the tube instead of making it. They've been approached from a supplier, and the supplier is willing to provide empty tubes, $1.35 for 24. So the same as the box that they put like a lip balm would be in the same size box. 24 lip balms in a box, 24 tubes in a box. If Sylvan Industries stops making the tubes and buys them, here's the effect on its costs. Its direct labor and variable manufacturing overhead costs will drop by 10%. Now remember what I said, manufacturing overhead doesn't say variable there, it says total. And the direct material cost would be reduced by 25%. So we have 8 different things to look at here. Now here's the first thing that's very important. If Sylvan buys its tubes from the outside supplier, how much of its own manufacturing cost per box will it be able to avoid? So what do we have to do? We need to figure out what part of this manufacturing overhead is fixed per box and what is variable per box. And here's how you do it. You take you take your total fixed costs, total fixed manufacturing costs. They gave them to us. So the portion of the manufacturing overhead that is fixed is $90,000. How much is that per box? Well, 100,000 boxes, 90 cents per box. So of the $1.40 total manufacturing overhead, subtract the fixed portion, 50 cents will be our variable portion of overhead. So how much does it cost just to make, or how much does it cost to make the tube portion? Or I'm sorry, I'm saying that wrong. How much will it cost? I was saying it right the first way. Just to make the balm. How much would it cost without the tube? So what are we going to avoid? No, I was saying it right. Back up one more time. So what we're going to calculate, the avoidable manufacturing costs. So how much won't we have to pay if we bought the tubes instead of making them? How's that? Hopefully I didn't confuse you. We know how much it costs to make, or what materials. Total cost of $360. 25% of them can be avoided if we buy the tubes. So 90 cents of the materials we wouldn't have to buy per tube. Direct labor, 10% of that could be avoided, or 20 cents per box of tubes. And The variable manufacturing overhead, remember, is 50 cents per box. 10% of that could be avoided. So if we don't make the tubes, our variable cost would decrease $1.15. That's what we would avoid. Sorry for the confusion there. Hopefully I got it straight, right? Hopefully you do too. So that's our first step. Determining how much are we going to avoid if we don't make these tubes. Now let's see what our options are. Is there a financial advantage or disadvantage then to buy them? Well, it costs $1. We're going to only avoid $1.15. If we buy them, it's going to cost $1.35. So it doesn't make sense for us not to make the tubes. Although it's going to cost us $1.15, it would cost us more to buy them from the supplier by 20 cents a tube. What is the financial advantage or disadvantage in total, not per box, if Sylvan buys 100,000 boxes of tubes from the outside supplier? Let's take a look. They buy 100,000. It's going to cost them 20 cents per box, $20,000 they're wasting by buying them instead of making them. Should Sylvan Industries make or buy the tubes? Well, that's pretty obvious. It should make them. What is the maximum price they should be willing to pay an outside supplier for a box of 24 tubes? What it costs, what the costs they are avoiding, that's what they should pay. That's the most. So if the costs to buy the tubes are $1.15 or less, they should buy them. But since they're more, they should just make them. Let's take a look at 6. Instead of sales of 100,000 boxes, revise the sales volume to 120,000. Now, at this higher sales volume, Sylvan would need to rent extra equipment at a cost of $40,000 per year to make those additional 20,000 boxes of tubes. Assuming the outside supplier will not accept an order for less than 120,000 boxes, what is the financial advantage or disadvantage in total if Sylvan buys 100,000 boxes of tubes from the supplier?